There is a lot of debate out there, particularly in the FIRE community, about what the best sustainable drawdown strategy is when it comes to living off your investments. Now, there are a number of strategies out there, but it appears that there's no current one-size-fits-all approach, like most things in finance. But Vanguard thinks they have a solution. Vanguard has introduced what they call the dynamic spending strategy, which is a total return approach to wealth drawdown, which alters your level of drawdown each year in line with investment performance. And the idea of this is it gives you stability of income while also protecting your portfolio in down markets. So in today's video, we're going to look at exactly how it works. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. Before we jump into the specifics of the dynamic spending strategy, let's quickly touch on some of the traditional wealth drawdown approaches that we've seen today. The first and most obvious strategy is the income-orientated strategy. And this is where you live off the passive income that's created by your portfolio. Now this makes a lot of sense, right? Because you basically eat what you earn and you leave the capital there to produce more future treats. But there are a few issues with this strategy. By focusing all your investments on income generating assets, you're missing out on some great asset classes. For example, international stocks. Now when you compare international stocks to Australian stocks, they don't produce nearly as much income. However, they are some great investments from a capital growth perspective. Also, in times like we're experiencing now with interest rates at record lows and a lot of big companies cutting dividends like the banks, it means that your income can take a real hit. And all of a sudden you might not be producing enough income in order to meet your living expenses. This is where the total return approach comes in. So instead of focusing on income solely, the total return approach focuses on income and capital growth. They essentially don't really care where the return comes from. And this opens up a whole new array of assets which you can invest in. Under the total return approach, many investors determine their drawdown one of two ways. They either use the dollar plus inflation rule or the percentage of portfolio rule. Under the dollar plus inflation rule, you set a specific drawdown amount at the start, and every single year you increase that drawdown amount in line with inflation. And what this does is it keeps your standard of living the same. A very well researched and a very well documented approach to this is the 4% rule. The great feature about the dollar plus inflation rule is that it gives you a lot of certainty in your cash flow. You know that you're going to draw down exactly what you did last year, except a little bit more to allow for inflation. And this is great for budgeting, and it's great for getting your spending habits to remain the same over the years. However, what it's not great for is it doesn't take into account investment performance, and therefore it can be a real big drain on your portfolio if markets have a bad year. Under the percentage of portfolio rule, your drawdown is recalculated every single year as a percentage of your portfolio at the start of that year. So if your portfolio goes up, your drawdown amount is going to go up. If your portfolio goes down, your drawdown amount is going to go down. Now this is great from a portfolio perspective because it protects your portfolio in low markets because you're drawing less, but it doesn't give you a lot of certainty around your income. Now I could spend hours arguing the pros and the cons of each of these drawdown strategies, but that is not the purpose of today's video. Today we're looking at Vanguard's dynamic spending strategy. The dynamic spending strategy is a total return approach to investing as opposed to just being income focused, which is great because it opens us up to a wide array of investments. Where it varies from the other total return approaches is in the way at which you draw down your income. This strategy is essentially a hybrid between the dollar plus inflation rule and the percentage of the portfolio rule, in the way that it draws down the funds. So it essentially tries to keep your level of drawings fairly stable, which helps with cash flow management, while also protecting your portfolio in down markets. Under this strategy, you first of all determine what you think a sustainable spending rate is for your portfolio. Now this is basically the amount of drawdown that you believe you can take from your portfolio in perpetuity, taking into account the risk that you're willing to take in your investments. And now, if you're not sure what this number is, you can always default back to the old 4% rule. Each year, you then adjust your annual withdrawal amount in line with the bandwidth. The bandwidth is determined by a maximum drawdown amount, which is referred to as a ceiling, and a minimum drawdown amount, which is referred to as the floor. Vanguard's research suggests that the ceiling is capped at last year's drawdown plus 5%, the floor is capped at last year's drawdown less 2.5%. So every single year, what you're gonna wanna do is you're gonna wanna calculate your sustainable spending rate and limit it to that floor or ceiling. Now let me give you an example of how this works. Let's assume that you have a $1 million portfolio and you determine your sustainable spending rate is 4%. We will also follow Vanguard's example floor and ceiling and assume a 2.5% floor and a 5% ceiling. To kick things off in year one, you draw down 4% in line with a sustainable spending rate. On a $1 million portfolio, this equates to $40,000. We'll assume that in this year, your portfolio generates 10% return, and therefore at the end of the year, you're left with an end balance of $1,056,000. To determine your drawdown in year two under the dynamic spending strategy, you need to do 3 calculations. The first is the amount of drawdown based on your sustainable spending rate. Given the portfolio is now $1,056,000, you drawing under the sustainable spending rate would be $42,240. Next, we calculate the ceiling. The ceiling is an additional 5% on what we withdrew last year. So 5% on $40,000 gives you a withdrawal rate of $42,000. And finally, we calculate the floor. The floor is 2.5% less than what we withdrew last year. So 2.5% of $40,000 gives you a total withdrawal rate of $39,000. Now that we have our 3 calculations, let's compare them. Our default withdrawal rate is the sustainable spending rate, unless it exceeds the ceiling or drops below the floor. So in this instance, it has exceeded the ceiling and therefore we will limit our withdrawal to the ceiling and take a withdrawal of $42,000. At the end of year 2, we will assume the portfolio has made an investment return of 5%, and therefore taking it into account our starting balance of $1,056,000 less our withdrawal of $42,000 and adding in our 5% return, we're left with a final balance of $1,064,700. In year 3, we go through the process again and calculate the sustainable spending rate, the ceiling and the floor just as we did in year 2. This time the sustainable spending rate is not above the ceiling and it's not below the floor, so we'll take the sustainable spending rate and withdraw $42,588. If we assume an investment return of 5%, at the end of the year we would be left with an end balance of $1,073,218. So as you can see, you make 3 calculations every single year. You calculate the ceiling, the floor, and the sustainable spending rate. And now the sustainable spending rate is your default drawdown amount unless it exceeds the ceiling or drops below the floor. As a result of this strategy, you get stability of income as your withdrawal amount isn't allowed to vary too much thanks to the floor and the ceiling, and you also get capital protection in a down market. Considering a safe drawdown amount is very important for anyone who's living off their investments. We're all living longer and therefore the chances of outliving our capital are increasing. While I do see the merits of the dynamic spending strategy, probably more so than the other drawdown strategies, I do think that there's never going to be a single strategy which is appropriate for every single person at every single stage of their life. You always have to take into account your own financial situation, your own investment portfolio, your investment outcomes, your health, your wealth. All of these things change year on year, and as a result, you need to review your drawdown amount year on year. Whatever drawdown strategy you do decide to run with, just bear this in mind. When markets are good, your portfolio will look after you. When markets are bad, you need to do your bit to look after your portfolio. But that's it for me today, guys. Thanks a lot for watching. Smash the like button if you like this video, and I'll see you guys in the next one.